After opening the week at 75.22, the domestic currency gradually declined to register a 16-month low of 75.8450 before ending the week at 75.77. Rupee's weaker undertone is set to continue as the Omicron variant persists, with the rise in cases may lead to travel and trade-related restrictions and dent economic recovery. The persistent foreign capital outflows and rise in crude oil prices also weighed on the rupee. Dollar is gaining against the major currencies as a result of expected Fed rate hikes in the second half of calendar year 2022, which fueled a weaker trend in the rupee to continue and possibly test the 76 support level with intervention from RBI in the interim period to smoothen the currency's fall. From the beginning of the current financial year till date, rupee has depreciated by about 3.20% and against the dollar, and it is quite possible to expect a depreciation of close to 4% in the domestic currency at the end of the current financial year. After recognizing the divestment inflows in the first quarter of calendar year 2022, it is hard to expect the rupee to depreciate beyond the 76.50 level by end of March 2022. In the 9th consecutive policy meeting, the MPC retained all the key rates as unchanged and maintained its stance as accommodative. The MPC said the accommodative policy stance shall continue until there is sustainable recovery in the economy. MPC noted the second quarter growth of 8.4% was largely due to base effect. India's retail inflation eased to 4.48% in October, but it is still away from MPC's ideal rate of 4%. As a result of the unchanged monetary policy, rupee breached the strong support at 75.80, but the selling interest from exporters could prevent the rapid decline in the domestic currency. With the forward dollar premium for 6-month maturity ruling at over 4.50% per annum, we strongly recommend the exporters to sell their medium-term receivables at the spot target level of 75.80 or better to enhance the export realization. The forward exchange rate for 6-month delivery is close to 77.50, and we strongly feel the rupee's weakness beyond the 77 level shall be contained by strong intervention from RBI, supported by robust growth in the economy and BOP surplus in the current financial year. Fitch Ratings cut India's economic growth forecast to 8.4% for the current fiscal year ending 31st March 2022, but raised GDP growth projection for the next financial year to 10.3%. RBI retained the CPI inflation forecast at 5.3% in financial year 2021-22. The partial rollback of central excise and state VAT on petrol and diesel in November have eased retail selling prices and will have second round effects on inflation over a period of time. As a result of unchanged monetary policy rates, the 6-month forward dollar premium dropped to 4.52% per annum from the high of 4.77% seen a week ago. The near-term forwards up to 3-month tenor are also expected to gradually drop lower in the coming weeks. Rupee successfully breached the 75.80 support on Friday as persistent foreign fund outflows kept pressure on the domestic currency. Rising crude prices in the international markets maintained a weaker undertone in the rupee to trade well above the 75.80 level. After a clear breach of 75.80 level, a test of 76.00 strong support can be seen, and the central bank is expected to intervene in the market to prevent the fall in the domestic currency beyond that level. The success of the PSU divestment plan in the last quarter of the current financial year is crucial to limit the rupee's losses. In the MPC policy announcement on Wednesday, RBI raised the quantum of existing variable rate reverse repo operations to rupees 7.5 lakh crores by end of December in their effort to nudge the overnight rates higher towards repo rate. This may be a precursor to raise the reverse repo rate by 25 bps or so in their next policy meeting in February 2022.